Hello and welcome to Wake Up and Smell the Mic S&P 500 review for Tuesday, January 10th, 2023. It's now the 9th. We start off in the S&P 500 daily chart looking back to December 2021. I'll zoom into the current area now. The S&P 500 has printed the combo and sequential sell setup 2 count. And to negate that for end of day on the 10th, there must be a close below 3852.97 for the price flip to the buy setup count 1 again. And the only level in danger of becoming qualified for end of day on the 10th is the 50% momentum up for propulsion. So a close end of day at the 10th on this level here. That level will become qualified, and this qualified supply line did not get confirmed. It was close, so there was a close on the 6th at this level, and then on the 9th it opened above the close on the 7th at this level, but then the close on the 9th was a little bit less than the close on the 6th. So technically that's not confirmed. And I have seen a lot of stocks in my scan today that are in this situation where it could have been qualified and confirmed their supply line, but it failed with the close under the previous close. The supply line has nonetheless printed a new supply projection at 3997.30. Right on top of the relative retracement disqualified up 1. And the S&P 500 weekly chart in DeMark looking back to COVID crash 2020. I'll zoom into the current area now. And the S&P 500 weekly chart's Bollinger Band is forming a pincher squeeze just like in the VIX. And the Bollinger Band in the weekly chart is using the 39-week moving average for the middle band and 2.5 standard deviations for the top and the bottom bands. And zooming back out to the COVID crash, the only reason why it's at a 2.5 standard deviation is that I experimented with it and wanted to get the top Bollinger Band as close as I could to these top highs over here for the bars, and the lower band to get close to the bars over here. And I zoomed out a little further back to 2019, and you can see that the top band of the Bollinger Band is right going along these highs over here in 2019, and the lower band was right around this low over here for that Christmas drop in 2018, but it pretty much matches these highs over here, and I wanted something to gauge for revisiting these lows over here, and it came pretty close over here on October 9th, 2022, and it's now forming this pincher squeeze here, so we could get a Bollinger Band squeeze on this pattern here in the weekly chart. And it's not going to happen in the next couple of days. This will take several more weeks to get closer together if price allows it to. If it keeps going sideways like this and just stays in a range, and that will get closer and closer together and form a squeeze, and price will have to make a decision one way or the other. Is it going to break out of the upper band, or is it going to break out of the lower band? So that's worth watching. The S&P 500 downtrend line chart. I'll zoom into the current area now. Things started out well for the morning of the 9th. There was an open at 3910.82, so above the Fortress Fed resistance line. Had a high of 3950.57, and at that time that was a very impressive upwards candlestick. And then everybody chickened out, it looks like, and there was a close under the Fortress Fed resistance and under where the close was for the 8th or 6th. And the only thing in the immediate future that I could see that could bring that on is tomorrow, Tuesday, on January 10th at 9 a.m. Eastern Time. Chair Powell speaks, and he's over in Sweden, so I'm sure he'll be talking down the rally. And looking forward, the consumer price index had better get beat from the last report. 0.1 positive. They have an expectation of 0.1 negative. So if that can be met or beat to the downside, negative 0.2 or so, that would be a very good thing. If it gets beat or even matches to the last report, 0.1, so if it matches that or gets to 0.2, that would be a very bad situation. And MarketWatch has core CPI edging up a little bit. If that can just stay even with the last report or beat it with a 0.1%, that would be good. And last report for CPI year over year was 7.1, and MarketWatch has it at 6.5. Anything under 7.1, maybe if it could beat this 6.5 or meet it, that would be good. Maybe even a little bit more as long as it's underneath this last report, 7.1. And same thing here for CPI year over year. If it could just beat this, that would be a good thing. And the CPI excluding rents and that could get that beat, that would be good. Again, anything to the upside of these would be very bad. Initial jobless claims from last week, I believe, 2004, as long as it gets beat to the upside and there's more initial jobless claims. MarketWatch has it at 210. I'd say anything that beats this to the upside would be a good thing. Continuing jobless claims, 1.69 million last report. So that needs to get beat to the downside. Let's check in on the VIX chart in DeMark. It's a daily study. And we're looking back to the COVID crash, 2020 right here. And I created this blue trend line, line 2, anchored at one point here and one point there, and extending out to here. So that's the low bar here. And it's also anchored on at November 26th. There was a low of 1142 and the line is at 1145. And the brown line is anchored at 14.78 over here on November 4th. Low of 1473. And here at August 12th, line at 1912, low of 1912. And the VIX went above that line 3 there today. I'll zoom in. And the VIX closed at 21.27, so for the 10th, the line is at 21.46. And there's a Bollinger Band squeeze somewhat forming here. You can see the top line here and the bottom line here forming a pincher. And the VIX Bollinger Band uses a 50 period middle band and one standard deviation on the top and the bottom. So that's something that bears watching to see if this squeeze gets tighter. And everybody's been writing off the VIX as being irrelevant, but I think it's going to make a comeback. And the problem is, and I don't quite understand it, is that volatility traders are using end of day expirations, like so they go day to day and get their options put on that way. So I think the VIX is going to matter again, and everybody's waiting for that capitulation move. So if the VIX starts moving up, gets past this 50 period middle band, Bollinger Band mid band, this bottom line for the Bollinger Band could start hooking around to the top and really form that pincher squeeze. The S&P 500 support and resistance levels big board chart shows the gray areas at the baseline, 26 bars back concerning the lagging line, the 50 EMA, and the 100 simple moving average. And price in the aftermarket hours on the 9th at 5:38 p.m. for the S&P 500 is 38.92. And to the upside is the weekly baseline, 39.08, 50 simple moving average, top of the cloud, 26 bars back concerning the lagging line, the Fortress Fed resistance, weekly diamond bottom extension perfect uptrend channel, and the pivot point. And to the downside is the 20 simple moving average, the qualified daily ongoing supply line, S1, daily horizontal support, trend factor down 2, the 21 EMA, and the daily conversion line. And if it starts the process over of going back above the Fortress Fed resistance at 39.06 and gets through all the other upper resistance in green, then the weekly conversion line is up at 39.32. Daily high channel 3 bumped up a little bit, and the daily baseline is at 39.33, and the weekly Bollinger Band mid band at 39.41. So there's a bit of room to run if it gets past that. And I highlighted the monthly support and resistance, 39.15, so get past that and then it can go up to these areas here. And the S&P 500 daily AD line is still above its 21 EMA signal line, and the NASDAQ 100 daily AD line is poised to jump over its 21 EMA signal line. And I'm sure the AD line would have been above the 21 EMA signal line today if it was able to hold on to those early gains. And all the large caps were in the red today, but look at the New York traditional McClellan breath oscillator bumped up further above zero. It would take 3,106 decliners over advancers to get back to zero. Yesterday it was 2,900 something. Have a great day.